Welcome, Financial Planning World. Dan Davis, President, Co-founder of 80K Wealth Advisory Group. As you know, we do the best practice videos as a part of really giving back to our financial planning community, because at this particular point, there are no shared best practices in our industry. I think that's a flaw. So hopefully over the next decade, we'll be able to rectify that. Independent fiduciaries really weighing in, saying, hey, how can we make the industry better? I'm joined with a special guest that I know from working out at the gym and got to know on a business level at this particular calendar year. So Michael Sandifer is joining us. And so Michael, tell the financial planning community a little bit about your background. How'd you get in the industry and how long you've been doing this?
Well, I used to be in music business. Well, actually, after college, I started with Arthur Anderson doing accounting.
Yeah.
Really wanted to be doing music for a living, so I moved to Nashville. But during that time, I met my wife, and so we dated long distance for a year, and so I felt like I needed a steady job after, getting married and stuff. So I went back to do accounting for another year. Then I actually did leave and started doing music and travel full time for about 8 or 9 years, all over the country doing concerts, especially in the contemporary Christian music.
Really cool. Yeah.
And one of those times, I remember a big fight that my wife and I were having on the way down to Tampa, Florida, that I hadn't reserved a reservation for us, for a hotel that night. And so we ended up doing the concert, and this guy comes up to me after the concert, and I recognized him, and he was actually a guy that had gone to church with me, although I didn't know him, but we went to the same church in Waco, Texas when I was at Baylor.
Yeah.
And he goes, well, where are you staying tonight? And I go, well, I don't know where we're staying. And he goes, well, why don't you stay with me and my wife?
Neat.
Yeah, a guy named Greg Snap. And he was an Edward Jones, guy, and very successful. And so we became really fast friends. And then every time I'd go touring in Florida, I would stay at his house, and he just loved it. He loved Christian music, and we loved talking about God and
awesome.
And stuff like that. So, when I decided, and it was probably, almost coming up on 40, my daughter was about 4 or 5 years old, and I felt like it is time to get off the road. This is a young man's game,
Right.
And I always had loved investments, and so I called Greg and got into the Edward Jones system, and
Neat.
Did that for a couple of years, and of course went out on my own a couple of years later.
Well, what really impressed me when we were talking was how you have really positioned your practice in such an efficient way that it runs and you're able to live the way you want to live versus the business running you. Tell the financial planning community a little bit about how you think that through, what you've done, and some of those types of things.
Okay. Probably has to do with, when I was at Jones thinking about, man, I'm just working too hard, and everything was very transactional.
Right.
And, having conversations with other Jones guys, nothing against Jones because it was a great place to start. But it was like, how can we, build a business and that's not where I'm not starting at zero.
Right.
Every month. And of course that was gravitating towards advisory and advisory fees. And I was about to go with another independent broker firm, but LPL's, their way of doing business really lined up with the way I wanted to do business.
Mm-hmm.
So it was from the very beginning there, it was gravitating towards an advisory type of business. And then once I started doing business with them, it's been kind of a constant whittling down of how I want to do business.
When you think about like some of the best ideas, call it one or two, that allow you to be able to run the business efficiently so it's not running you, what would you say are those one or two ideas that really resonate with you, that if you were on the side of the community listening in, that you would like to tell them that if they're not doing, they ought to think about it?
Yeah, I think the first thing that I started getting attracted to was being able to, block trade and how efficient that was, versus looking at every single portfolio that I had and having to make transactions there. And then also just the concept that you hear literally every day, in terms of promotion, when advisors are promoting themselves, they talk about, we're going to customize your portfolio. And I get with clients and tell them, I'm not going to customize your portfolio. How can I possibly keep up with, 200, 300 investments over my client's book of business? There's no way I can do that on a daily basis.
Right.
And so if I don't customize and your portfolio looks like someone else's portfolio, then I can look at one of your portfolios and I basically, in a sense, looked at my whole book of business. So that was probably the most significant thing I did. And if I needed to get out of a position, that I can get out of it, book wide.
Awesome.
Yeah.
So do you run then just like one growth with income model? Do you work different models like growth with income? How do you work through that?
Yeah, just aggressive growth and income, income with moderate growth. I've got capital preservation, but I kind of question whether I should even be doing that. I think that, especially we see the most conservative people now are the ones that are actually suffering the most because of how bonds have performed this this year.
Been brutal.
And it's like, what's the benefit long term of that? Really.
Understood.
Yeah.
So then you referenced block trades and then not customizing, but having models that you're using. Anything else that you think of that you believe really helps you make your process really efficient?
I try to limit how much stock I invest in.
Okay.
Because then I'm actually having to do research to get into a stock.
Right.
Do research getting out of a stock and then getting back into a stock.
Right.
And the level of research time is kind of crazy.
Yeah.
And then a few years ago, I was back in 2008. I actually got people out of the market earlier because I was doing technical analysis and looking at charts, and got everybody out early. But then I had to ask myself the question: if I'm going to be honest and get people out based upon this technical analysis, then I have to use the same criteria for getting people back in. And of course, I was late getting people back in based on that same criteria, and I looked back and thought, well, how well did I do relative to somebody who had just left it in?
Yeah, yeah.
And I realized that I hadn't really done any better than someone who had just kind of stayed in there, although they probably had a little bit more of an emotional roller coaster ride than people who got out.
Yeah, getting it right on both sides is pretty tough.
It's tough. It's tough. You can't do it. I mean, yeah. And then you think, well, and then you do the analysis and you think, okay, well, I'm just going to get people out earlier and use a shorter time frame. But then you realize the shorter you go, the more transactions you're actually doing, and you're whittling away their portfolio just by transaction fees and capital gains and losses and that kind of stuff. So it was better just kind of. So now my conversation with my clients, and I love what this top producing advisor used to say. He goes, a lot of advisors are going to tell you how much they can make you, how much they can earn you. I'm going to tell you how much you can lose. And so it's changed the approach of, this is what it's historically done, but the closest thing we know to a worst case scenario was 2008. This is how much this portfolio has gone down. It went down in 2008. Are you going to be calling me if it goes down this much? Because if you are, you don't need to be in that risk tolerance. Right. And so that's kind of a way of preparing them on the front end. It's like, we want to be staying in the market, and where's your risk tolerance there?
What tools do you use for that kind of analytical meat and potatoes of the data?
I think I just went back to Morningstar data.
Nice.
Looked at the returns.
Yeah.
During that time, and then also just how much they were actually down. I actually just have a little piece of paper that shows the returns and the downside volatility for 2008.
One of the things when we were sitting on my back porch having this kind of conversation that blew me away was the research you had done that resulted in you avoiding Developed World International. Tell the group a little bit about that, because I have to say that was when we were having that conversation. That's when I knew that we needed to do this interview for the financial planning world community, because I was just like, wow, I've been doing this for 30 plus years and my degree is in investment finance. I had never heard that before. But I went back and looked and it was legit.
It was legit.
Yeah,
check the numbers and stuff.
Well, you have to.
Interesting. That's good. Yeah. That's good. Well, I think that, we're just taught, and I've heard it from every wholesaler, is like, you need to be invested internationally.
Mm-hmm.
And I think any advisor that's, in the last 5 years has realized how it seems like every single year that the international has been detracting from their portfolio and bringing it down.
Right.
So I finally just like, okay, let's just look at the numbers and what's done. And to me, I approached it from a standpoint, it really doesn't matter what it does on a yearly basis, but my clients are interested in what it does long term to their portfolio. So I started looking at 3-year, 5-year, 7-year, 10-year rolling returns to see, how much, international is actually helping. And then I would just add 70% Russell 3000, 30%, Morgan Stanley EFA index.
Mm-hmm.
And, come to find out, I think on the 3 and 5 year basis, it was about, domestic only was outperforming over 2/3 of the time.
That's crazy to think about.
7 and 10 years, it was more like 75% of the time.
Yeah.
But it was interesting because it moved in cycles. So there'd be, cycles where international really was contributing, year after year, and then it would go out of favor for a cycle, several cycles.
Right.
And then with emerging markets, I looked at emerging markets, not as much of not 30%, but maybe 10% in there. And about half the time it actually, in all periods, it actually added to your portfolio or took away. So
yeah.
So
yeah, that point was really interesting because having done this for 30 plus years and studied investment finance, we were so indoctrinated with that Ibbotson concept of asset allocation. And over time, I've continued to believe in diversification, but moving away from the theory of asset allocation in its cleanest form. And after we talked, I went back in and looked at it, and for other shorter term reasons, we removed Developed World International from our model altogether. So hopefully that plays out, and then I'll owe you a drink. So
yeah. It'll go back.
Yeah.
I mean, who knows? I don't really know. We hadn't really looked at why it's doing that and why it's not helping, but
we're gonna do Scotty Kenley, who's doing some research on our team, is looking into the effects of the dollar on that. So I'll fill you in. That's a longer term project because we don't have the data easily accessible on that. So I'm going to wrap us up. So financial planning world, I think a couple key things. One is really how do you make your practice the most efficient in looking through doing that relative to models instead of all these custom portfolios. At about year 20 for me, we were still running custom portfolios, and I literally met with 2 relatives back to back that were both following our growth with income, and the variance of the return was so different that I realized at that point that I couldn't do that anymore. I didn't know the solution, and it took quite some time to unravel from that. And then once I made the commitment, it took 2 years to get to where I could actually do batch trade. So I would highly recommend that. And then take a look at your way of doing research and go into financialplanningworld.com and weigh in on this video as to what your research shows about emerging markets and international. Let's have a little dialogue on that. So in closing out, thanks for your time. Share best practices. Best way to do that, reach in through the website. You can schedule a 15-minute conversation. Would love to hear what you have to say and see if we can share with the community. From Nashville, Tennessee, specifically the Williamson County area, we're going to sign off. Have a great rest of the day.